Well, there's certainly not a one-off. I think I don't think I've ever watched a congressional hearing where there hasn't been a high degree of grandstanding and clairvoyancy. But what we've heard doesn't really get to the nub of the problem, which is that banks have been encouraged by regulation to invest in low credit risk liquid assets, which is actually what got Silicon Valley and in fact Signature, although Signature had other problems as well, into trouble. And essentially, this was a bank with a cash flow problem. There are two ways in which banks can go bust, liquidity and solvency. And Silicon Valley was solvent, but it lacked liquidity to meet customer withdrawals. And that is what caused its demise.
Make you wonder whether if this bank were properly supervised, whether those liquidity issues would have been uncovered. If we think about the rollback of Dodd-Frank rules that effectively saw slippage from the threshold of 250 billion to 50 billion in assets, this meant that the bank wasn't subject to the same level of oversight. Do you think it would have uncovered some of these issues if we had had regulators looking at the bank more closely?
No, I don't. And I think there's a high degree of political opportunism with those allegations. I think that regulators were actually encouraging banks to use excess liquidity to invest in securities portfolios. And what we saw at the time of COVID was this tremendous credit and deposit creation from this incredible stimulus. And banks, given that they couldn't lend it out, were effectively encouraged to invest in securities portfolios. And I think Silicon Valley Bank actually had a fairly normal degree of duration risk in its securities portfolio. The problem is that it had a cash flow problem in terms of lack of maturing assets to reinvest at higher interest rates, and lack of new deposits to also reinvest at higher interest rates. And that meant that it couldn't fund its current securities portfolio and therefore had to sell assets which realized losses. It wouldn't have made losses if it could hold those to maturity. But it also, crucially, didn't have enough cash to meet depositor flight when depositors got wind of the other issues at the bank.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.